I'm Gary Venner, CEO of IFA Acquisitions, and I'm joined by Glynn Mummery, insolvency practitioner and partner of national business advisory firm FRP Advisory, where we continue our informative question and answer series on our YouTube channel to provide top tips when selling an IFA business and an insight into market conditions faced by company owners that are looking to exit and liquidate. The title of this video is coming up on our screen now. Now, the London Gazette, I always hear it's going to, the firm that's going to go through an insolvency is going to be mentioned in the London Gazette. Does that exist?
It does exist. It does exist. It's obviously a little bit of a throwback to times gone past, but it's a public notices newspaper. It's available online, as you'd expect it to be, and any notices are put into the London Gazette, and it's deemed to be notice to the world, and that's notices regarding solvent liquidations, insolvent liquidations, administrations, etc. But it's also any other public notices as well. They all go into that London Gazette. You have to Google it. Have a look.
Google it. I need to buy the London Gazette. I think just to have that. So obviously it's quite complex, but if there is a solvent, winding up of a company, can that be done by the company's owners, or does it have to be done through a liquidator?
It all depends on the amount of assets that are being distributed back to the shareholders at that point. If the assets are above £25,000, then it is deemed it should be done through a liquidator. And that's an HMRC recommendation. If it's below £25,000, then it can be effectively managed within the owners of the business, and they can get their firm struck off, dissolved as we would call it, and they can then distribute assets less than £25,000 to themselves. And that's it's called ESCC 16, an extra statutory concession that they can do that.
Fantastic. So I'm assuming with most of our IFA acquisition sales, it runs into hundreds of thousands or millions in the consideration value. And particularly if it's an asset sale, and those assets, once they've been purchased, will go into that company. So the actual company could have quite substantial funds within that. When you talk about 25,000, obviously very low amount.
Yes.
But could that company have made distribution of dividends, etc., or pension payments, etc., to reduce that 25, getting towards that 25,000?
You're absolutely right. In that set of circumstances, what's important though is that the directors, shareholders liaise with the accountants and their tax advisors to decide what is the most tax efficient process or method to get the money out of the company, as to say. And in those circumstances, pension contributions, dividends, if that's what the accountant advises, then absolutely. And if that takes the asset values of the company below that £25,000 mark, then they can look to simply have the company dissolved at that point in time.
And that's really interesting to know this figure as well. And I'm guessing with the sort of size deals that we're involved with day in, day out, that it would be very difficult to be able to do enough tax planning to do that. So I'm assuming that your role as a liquidator is very much needed for a lot of these final closures.
Yes, you're absolutely right. I am aware of some circumstances where it's been necessary to keep an IFA firm open for a prolonged period for whatever run-off insurance purposes that may be in place, and the directors stroke shareholders have operated, say, dividend policies at that point, and actually that's got it to a point where it can be simply dissolved at the end. But in the vast majority of cases, that members' voluntary liquidation route gives the shareholders, number one, the certainty regarding the distribution, because we've advertised in the London Gazette for all potential creditor claims. And if creditors don't claim within that 21-day period, they're locked out. We've got tax clearance from HMRC, and so they can be assured that the money that has been distributed to them is their money, subject to that deed of indemnity in case of any claims from the FCA at a later stage.
Brilliant, thank you. And my last question on this really is, so what sort of fees are likely to be payable for instructing a liquidator to undertake this work?
Right. So it very much depends on the state of the company when it comes to us. If it were a situation where we are looking at a business that has been deregulated, simply cash at bank, minimal shareholders, and it is very, very straightforward for me to put that business into liquidation and carry out that distribution, I would suggest you're looking somewhere between £3,500 to £5,000 for a liquidator's fee. There are disbursements. Those disbursements include the adverts in the London Gazette, £290 currently to be exact, and also there's an insurance bond. There's a general bond that all insolvency practitioners must have, which gives protection for the money that's under our control. And that is a scale that's on a sliding scale depending on the value of the assets that are being distributed. For more complex members' voluntary liquidations, of course, those fees increase and they can become quite substantial, depending on the size of the firm. It's almost how long is a piece of string. But what I'd recommend to anybody out there that they're looking for quotes, go and see an insolvency practitioner, explain the position that you're in, give a full explanation, and look to get quotes and really just test the market.
So Glynn, how important is it to use a liquidator that fully understands the FCA requirements for deauthorisation?
It is definitely important. There are two reasons. Number one, from an insolvency practitioner's point of view, there is an insolvency code of ethics that states an insolvency practitioner should only accept appointments where they consider that they have got the relevant experience and expertise to execute that appointment. So that's number one.
Yeah.
Number two, the FCA themselves require that an insolvency practitioner will understand the permissions and the regulatory framework that sits around that particular firm they're dealing with as well. So it is an important factor.
That's good to hear, that really is. And types of things that the FCA are going to expect a liquidator to have done to put in place the deauthorisation of a firm.
The FCA has a role in every firm that is regulated, whether or not it's going through an insolvency process or not, or indeed a solving process. One of the key issues, of course, is harm to clients and minimising that risk as well. So that's going to be a key factor. The second thing is client monies, making sure that all communication is very clear, any client monies have been properly dealt with, that they understand what's happening and that their prior approval has been sought. The client book, if you're looking to transfer it, that's been conducted in a proper manner, and again to the satisfaction of the FCA. But I can never emphasise enough the importance of talking to the FCA at the earliest stage to make sure they are comfortable, to make sure that they're on board with the signposting that has been put in place to ensure that the client's interests are protected. If it's a members' voluntary liquidation, the FCA are going to expect that the insolvency practitioner has put that declaration of solvency together that we referred to in an earlier session, and that all the contingent liabilities are properly identified. Those contingent liabilities include complaints with the Ombudsman as well, and making sure that there is a system in place to deal with those complaints, and if necessary, redress can be made. And they also expect the insolvency practitioner to monitor that member's voluntary liquidation, because a solvent liquidation with issues contingent liabilities can of course become insolvent if those contingent liabilities are greater than was first expected. And they do expect the insolvency practitioner at that point to be vigilant to it and then be converting it from a members' voluntary liquidation, solvent liquidation, into an insolvent liquidation, which would be known as a creditor's voluntary liquidation.
Sean, Glynn, do you find that an accountant will often work in partnership with the liquidator to help provide the information needed for this process?
Yes, very much so. And I think it's not just an accountant, it's a team. There's legal advice, there's tax advice, there's advice on the disposal, and it's all about fully understanding the assets that we're dealing with and making sure that if they are distributed or they're being distributed back to shareholders, it's done in the most tax efficient method.
Yeah.
From a liquidator's point of view, then let's just assume the company's gone into solvent liquidation and I have assets to distribute. We can distribute cash, as you would imagine, it's quite simple, but we can also distribute assets, and we call that a distribution in specie.
Yeah.
So, for instance, if there's a freehold property, we can distribute that to the shareholders. The only issue is making sure that the shareholders are in agreement on how that property is distributed and making sure we know what value they've all agreed on. And again, that wouldn't be my responsibility. My responsibility would be just making sure that the shareholders were in agreement with the plan.
Subscribe to our YouTube channel and switch on post notifications so that you won't miss our next video in this series when we discuss market conditions faced by company owners that are looking to exit and liquidate, and an insight into M&A situations by two industry experts, me, Gary Venner, CEO of one of the UK's largest specialist brokers in IFA acquisitions, and Glynn Mummery, insolvency practitioner and partner of national business advisory firm FRP Advisory, who are a leading national business advisory firm.